you. It's my great pleasure to welcome all of you today at our event. Uh, I'm very grateful to our esteemed speakers of today's webinar and to those who find time and seen and listen to us online. Thank you for this. Today we have the second event in a row organized by IFA Ukraine. This time we decided to look outside Ukrainian borders and to discuss, to see, to share with colleagues and to listen to our colleagues from EU jurisdiction what is going on in tax domain there, how they do implement the BEPS package through directives, EU directives, directly into their legislation. What implications do they face? Are there any similarities? What are the differences in approaches on implementing these packages? And definitely a very important issue, how it may affect Ukraine in various aspects, how it may affect Ukrainian businesses doing or just presenting in respective EU markets, what lessons may be learned from that, and at what points the attention should be paid in order just to minimize the risks and to navigate in the business with the open eyes. So we've chosen 4 countries which seem to us quite interesting in that respect. That will be Cyprus, a traditionally important Ukrainian partner in terms of financial services, trading and structuring. That will be Poland, our closest neighbor, and more Ukrainian businesses structure and pave their way to European Union through that jurisdiction. And also we'll look into the experience of Luxembourg and the United Kingdom. Luxembourg interesting as a financial center, and how it reacts in that way will be indeed interesting. And the UK as a EU departing jurisdiction may learn or just may teach us certain lessons as well. We understand. So my great pleasure to present to you our today's panel speakers. That's Mr. Demis Ioannou, partner from Taxand Cyprus, who specializes in transfer pricing and corporate taxation. His colleague, Mr. Costas Savva, also partner from Taxand Cyprus, with interest in the fields of VAT and corporate taxation. Ms. Malgorzata Karbowiak, partner from KKLW, Avidbiz partner firm. Mr. Costas and Mr. Demis definitely will be speaking on Cyprus. Ms. Malgorzata will share with us the Polish experience. Mr. Gaspar Lopes Diaz, also partner from Taxand Cyprus, but who works extensively with and in Luxembourg and the United Kingdom. So he'll be talking about these jurisdictions. And yeah, definitely far from being pleased though last, Ms. Natalia Rudenko, Senior Manager at Deloitte, Ukraine. The speaker who needs no special introduction, let's say, well-known and regarded tax expert in Ukraine. She'll be talking about the Ukrainian experience and Ukrainian perspective and vision on particular cases which involve Ukraine, but related to EU jurisdiction. So that's the composition and design of our today's event. Each will have 10-15 minutes of introduction. Then we'll have a discussion of the topic. I invite all of you to put questions which are of interest to you in the chat in either of the languages, Ukrainian, Russian, English will do, and we'll do our best to address and to answer them in the course of our event. So having said that, I'm passing the floor to our first speakers, to Mr. Demis, Ioannou, and Costas Savva. Colleagues, the floor is yours, and we are preparing the questions. Okay.
Thank you, everyone attending this seminar. We will go very quick about several BEPS issues in Cyprus and some tax insights, what we expect soon. So first of all, just to say, give me a second just for the slides to be fixed. So BEPS action plans. We are all of us are very familiar of the action plans of BEPS that they have been initiated from the OECD, and they have implemented in several countries as of 2015 and onwards. You know, Cyprus, even though that is not is not part of the OECD members, it has implemented all BEPS up to now, mostly through ADAT. As you may all know, European Union was part of the discussions with the BEPS from the beginning. So when the discussion started back in 2012, EU was a partner in these discussions. And as of 2015, when the BEPS were prepared and ready to be released, EU has drafted a directive for the EU members and released the ADAT 1 year after, in 2016. As you can see from this slide, very thoroughly, you can see that ADAT, the tax directive of EU, has not only implemented the BEPS, it went one step further. So we have all, through ADAT, we have not only implemented BEPS initiatives, but as I said, something even more. So most of the most important BEPS, which is the PPT, the interest limitation, CFC, and hybrid, has been implemented. PPT, the principal purpose test, has been implemented through the MLI, which has been ratified from the Cyprus Parliament early 2020, applicable as of 1st January 2021. The interest limitation CFC and hybrid has been implemented partially through the ADAT and now is part of our legislation. The only thing that it has not been yet implemented in Cyprus is the reverse hybrid, which will be implemented this year and will be applicable as of January 1st, 2022. Now, the MLI, as I said, it has applied and ratified 2020 and is applicable 2021. The most important section, the Article 7, for the prevention of 3D abuse. I think this is the one that will be very important, especially for international companies that they do international business. The principal purpose test, in few words, says that unless you have a business reason, you will not be able to utilize or use the 3D benefits. Now, this is a very important. Obviously, it's based on the LOB that the US government has implemented years ago. There are a lot of court cases which give guidance on this element. Nevertheless, we need to assess case by case in order to be able to understand whether a company will be able to benefit from the treaty. Practically, the tax office, we don't expect the tax office in Cyprus to do something, but what we expect is the governments, the tax offices of other governments, for example, Ukraine, if they have any problem to give the benefit, because, you know, if you have a Cypriot entity, is the source country that we will provide the benefit and not the resident country. So we expect that as soon as the corresponding country and their tax officers will be ready to have extensive review on the MLI provisions, this will be shifted in Cyprus as well. I think for the big clients, it will not be far away from now, because obviously, as a practical point of view, the tax officers, they first go after the big clients, the big fish, and then slowly they will go to smaller clients. So for big clients with significant transactions outside the source country, we expect that very soon it will be reviewed and tested by the tax authorities. Now, as part of our BEPS and MLI, Cyprus trying to be to implement several rules in order to comply with all this happening around. Because of the limit on time in this seminar, we are going to explain just some of them, which we think that they are of great importance for the clients that they have Cyprus entities. And namely, we are going to explain transfer pricing rules, which my colleague Demis Ioannou will explain, and CFC, again, something very important. And obviously, at the end, we are going to discuss furthermore the new directive, Tax 6, which it has been implemented in Cyprus just 2 months ago. So it's something new, and we are going to explain it a little bit, how it works. And some tax insights, what we expect in the next couple of weeks, even days, if you're asking me. And this will cover the Cyprus side. And then my colleague Gaspar, which is based in London, in the UK, and has several experience in the Luxembourg, as he was working as a tax lawyer in Luxembourg for several years, will explain the tax insights in London and in the UK. So I pass now the stage to my colleague Demis, who will explain, as I said, transfer pricing and CFC rules.
Yeah, thank you, Costas. Hello from my side as well. Nice meeting you. My name is Demis. I will discuss about the transfer pricing rules. We have many questions from our clients. What is happening regarding transfer pricing in Cyprus? Maybe just a little bit of background. I think will help everyone to understand where we follow, where we go as a country. In Cyprus, although we have an income tax legislation for almost 80 years, up until 2016, there were no any transfer pricing rules, any detailed transfer pricing rules. What we had in our income tax legislation were only 4 lines of legislation that was referring to the arm's length principle, but however, without saying how you apply that. So the market was applying arm's length principle in a very generic format, finding market rates in a very generic way. From 2017, we had the first transfer pricing rules. It was a circular from the tax office of Cyprus, which says that for specific transactions. What are these specific? Are the back-to-back financing transactions. So for these back-to-back financing transactions, the taxpayer has to do a detailed transfer pricing report to support the arm's length. So this was a big jump in the Cypriot taxation because in one day, the advisors in Cyprus and also the client had to do detailed transfer pricing studies. Going forward now, and I think that's the important, is that we know from Cyprus discussions is that this year there will be a detailed transfer pricing legislation that will touch in all the related party transactions, not only for the financing, the ones that I just explained. So a new rule is expected in the next few months that it will tell you, this legislation, that for any related party transactions, of course, it will be some thresholds. We have to wait and see what will be the thresholds. But in general, in all these related party transactions, the taxpayer has to do a transfer pricing study to say that, yes, the transaction complied with the arm's length. And how the taxpayers, they will do that? The legislation probably, it will relay the transfer pricing rules of the legislation of Cyprus to the OECD transfer pricing guidelines. So there, the OECD transfer pricing guidelines, as we all know, is a detailed book from the OECD, around 600 pages, that gives you very detailed explanation how to do the transfer pricing study. So that's a bit of the transfer pricing rules, what we expect in Cyprus. From a practical perspective, the clients actually, they are telling us, and we're telling them that even that there is no detailed transfer pricing legislation now in Cyprus, since we expect to be in the next few months, we suggest to them that the prices that they will do now, given that there is no legislation, let's do a transfer pricing study from now, since to find the correct price, and then not to have to change the agreements and the prices after the legislation will come in force. Since the legislation obviously will be based on the OECD transfer pricing guidelines, Cyprus is an EU country, is the last one that will implement the transfer pricing legislation. So therefore, we recommend the clients, the taxpayers, that given that this legislation is coming, let's be prepared, and the transaction from now, even from last year, has to be at least in the arm's length range. That's for transfer pricing. I will move to another hot topic that our clients in practice, they are asking about us. As my colleague Costas has explained, the EU law anti-avoidance directive, which is directly applicable to EU member states through the directive, what allow us to do? The directive passed from the Parliament of Cyprus, so the EU legislation, because the directive passed from the Parliament of Cyprus, and we implement the anti-tax avoidance directives. These directives, one of them is about the CFC rules. So it's a legislation that says about the CFC rules and has been incorporated to Cyprus income tax legislation. As we might know, Cyprus used very often to big groups for holding structures. So when we see holding structures, now since we have these CFC rules, the first thing that comes to our mind as practitioners is to check about the CFC problem, because the CFC problem kicks in when you hold shares in another company, in another foreign tax resident company. So when we see a holding company, immediately we say, okay, let's check about CFC rules first, then we'll do anything else. The CFC rules, I think globally, more or less are the same. I think the Ukraine as well has CFC rules. Is more or less the same. Although there are differences, the idea is the same. If a company, a Cypriot company, for example, controls more than 50% of a foreign company, this is the first test. And in addition to that, the second test is that the foreign tax resident company is taxation is 50% lower than the Cypriot taxation. We have a CFC rule. Usual structure is a Cypriot company holds offshore companies, BVI, Seychelles, and etc. So when we see this, then we are in the scope of CFC rules legislation in Cyprus. Of course, these rules are quite detailed because are not Cypriot, are also EU, so quite lengthy. But just the overall is two tests. We check the shareholding of to the foreign company, and then we check the taxation in the foreign country. If we meet these two tests, as I said, so if the Cypriot company owns more than 50% of the shares in a foreign company, and in that foreign company, the taxation is 50% lower than the Cypriot tax rate, we have a CFC rules. But again, there is an easy way out, so it's not something we should scare us, it's something to be aware of. There are some easy ways to go around it by the legislation itself. So the legislation is telling us that the profits that you will tax, so the Cypriot company, it will tax those profits that are not distributed from the offshore company. So if that offshore company, for example, distributes the profits of the year, then there are no profits left on that offshore company. So the CFC rules will get zero. So one way to do that is we are just saying to clients, please make distributions, because when you have an offshore company or any other company, and that other company distribute to the Cypriot company, we know in Cyprus that dividends are exempt from taxation. So we don't see big problems here. And that's why we're saying to clients, please make a distribution to the Cypriot company to avoid any CFC rules problems. The other, which is a bit more subjective test, how we go around, let's say one client said, no, I don't want to distribute anything to Cyprus. Okay, fair enough. The other, the Cypriot legislation allow us to go around is by saying this transfer pricing test, they call it transfer pricing test. So the CFC rules in Cyprus are telling you that if you prove that the activities of the offshore company has no connections with the directors of the Cypriot entity, then again, there is nothing to capture. So summarize. First, rather easy way to go around the CFCs is distribution of dividends to the Cypriot entity. If this is not feasible for any reason whatsoever, there is another way around to prove that the directors of the Cypriot company has no any connection with the offshore company. Connection means decision-making. So the directors of the Cypriot company has not taken any decisions on behalf of the offshore company. This is the second test that you can go around. So that's a bit of the CFC rules. Usually I spend maybe 1 or 2 hours explaining this, but that's the bigger picture that I wanted to say today. I will pass it to Costas for covering DAC 6, and then I will jump in to cover another topic. Costa?
Thank you, Demis. So DAC 6, something very new in Cyprus, very old already for European Union. It has been implemented, I think Germany was the first, early 2018. In Cyprus, we has just recently implemented DAC 6. March 18 of 2021 has been implemented, applicable as of 1st January 2021. But keep in mind that when the directive was drafted from the EU technical party, tax technical party, it was specified that we should cover all the transactions started as of June 25, 2018. So regardless if we have just implemented, this directive is applicable for transactions took place after June 25, 2018. Now, what is DAC 6? First of all, I have to go one step back and say that it falls under the sphere of exchange of information. As you know, there are three different pillars of exchange of information. Is the simultaneously exchange of information, meaning that as the tax office reviewing one company and finds out or discovers that there is something tax avoidance in another jurisdiction, is obliged to report it or exchange it, this information, to this country. Obviously, you need to have the relevant law to be able to do it. So the simultaneously is usually in the tax treaties under Article 24, exchange of information. 23, 24 depends from the treaty. So this is the thing simultaneously. We have the upon request, which is the most famous one, if I must say. And again, we use the treaties, the bilateral treaties, to exchange such information. In our lives, in the last decade, we have seen the automatic exchange information. So we have the FATCA at the beginning, CRS, country by country, and now this one, DAC 6, which actually fails, as I said, under the pillar of automatic exchange information. It's a mandatory reporting because it's a directive. It has been transported into our legislation. And it's just to enhance the transparency for tax avoidance. Now, this is the new thing, if it's new, the new thing is that this exchange information is shifted to the intermediaries. Usually, the issue was between authorities and governmental authorities. At this point, it has been shifted to intermediaries. There is very detailed analysis in both in the directive and now in our legislation. What do we mean by intermediary? Even the preamble of the directive actually it spends one page explaining that. Just very quick. We mean fiduciary, lawyers, accountants, sometimes the bank, and even the taxpayer itself. There are some exemptions from this. One exemption, I think the most important, and I think is very relevant for our discussion, is if the intermediary is not based in the EU. For example, if for the implementation or for the design of or for the structuring of one transaction, there is involvement of a Ukrainian tax lawyer. As I said, because the intermediary is not based in the EU, this office, this lawyer or this tax advisor has no obligation and it cannot quote by the law. Nevertheless, and this is the important one, is shifted to the taxpayer if we consider that there is no intermediary based in Cyprus, for example, or in any other EU jurisdiction. The issue and the responsibility is shifted to the taxpayer and their directors. Now, if you don't do it, the EU was very clear from the beginning. the countries, the jurisdictions, the EU members, they should implement strict penalties in order to force the intermediaries to comply. So the penalties are not, are not the ones that we are using in Cyprus. So there is administration penalty of 20,000 euro in each case that the intermediary or the taxpayer does not comply with this regulation. Just to say an example, I was reading this morning, in Germany, the penalty is 25,000 euro. So you can imagine that Cyprus is not far away from most of the European jurisdiction. The next slide, please. So, as I said,
like 3-5 minutes, if possible.
Okay, I will finish and I will pass to Gaspar. So very quick, as I said, March 18 is the day that we have implemented, applicable as of January 1st, 2021. It catches cross-border arrangement. Now this cross-border arrangement, it catches both arrangements with EU members and with not EU members, so meaning third countries. But the key point here is that we are looking if this transaction has affected the tax base of the European member jurisdiction. Okay, this is it for me. Demis now will explain very quick the Cyprus tax insights, what we expect.
Yes, very, very quickly, since we're running out of time, some things that we are waiting this year in Cyprus, and it's good for taxpayers to know about it. We expect that a withholding tax, Cyprus has no withholding tax, as we know, for dividends and interest. We will include withholding tax now for dividend, interest, and royalties paid to EU blacklisted countries. EU has a list that is updating it frequently, so we check that list. For example, today is Samoa Islands, Seychelles Islands, and etc. So we're talking about offshore jurisdictions. In addition, Cyprus will introduce, in addition to the existing corporate tax residency test, so we will add on the incorporation test as well for countries. Actually, this is more an anti-avoidance provision. We want to capture countries that are incorporated in Cyprus and management control, nowhere, or in countries that the management control is not a test for corporate. So simple, we will add another corporate tax residency, the incorporation. So if a company is incorporated in Cyprus, then this company will be tax resident in Cyprus. And I already explained the transfer price rules. So I will now pass it to Gaspar, so he will tell us a few things about Luxembourg and the UK. Gaspar?
If possible, Demis.
Yes.
Yeah, we may just come back to Gaspar in 2 rows. Just first, there are some questions with respect to Cyprus, if possible, yeah. And I would like just to ask some of them to you. And then, as we just planned, we'll go to Poland and then come back to UK and Luxembourg, okay?
Okay, sure.
Yeah. So thank you very much indeed for this very detailed and profound overview of what is going on in Cyprus. Really, we appreciate very much. In Ukraine, you may imagine it's quite important what is going on in your jurisdiction. As I understand, there are a lot of changes to be introduced with respect to transfer pricing that may affect all trading structures of Ukrainian businesses who use Cyprus as a trading jurisdiction. And also, I understand that for those who have some holding structures there in Cyprus, ordinary situation when we have Cypriot holding with shares in Ukrainian companies or shares somewhere in offshore of low tax jurisdictions, there should be some additional attention with respect to CFC rules. What about substance requirements to different types of structures like trading or holding IP, whatever? Are there any changes or are they strict? How do you feel and what would you recommend to Ukrainian business, whether just to pay attention to this issue or no, and how it will be evolving with the time?
Okay, very good question, actually. A lot of jurisdictions, competitors, if I must say, they have introduced substance requirements in their countries, mainly not to cover, but is to push the relevant countries to have some substance requirements. Cyprus at the moment, we are not considering to have any substance requirements. Obviously, first of all, I have to say that the first thing that we have done, probably you know, when you request for a tax residency certificate, there are already some questions covering some substance requirements. So at this point, we have just this requirement. For example, if the directors are taking decisions in Cyprus, if there are offices, if there are any power of attorneys, general, specific, and so on. So this is what we have in our legislation. As I said, at this point, we don't expect that the Cyprus government will introduce something further more than this, because for two reasons, and I will explain my view, and probably Demis is good to share his view. So my view is that, because we have so many new things, and because of the transfer pricing legislation, which will be introduced soon, which the substance in each case is different, depending on the activities of the company, of the risks that the company takes. So it will be better to wait to see what the legislation, the new TP legislation will say. And then after, I think as a country, we will be able to start thinking what kind of rules, substance regulations we can implement.
Thank you very much. Yeah, okay, so with the tax residency certificate, that's we're facing for a couple of years already. I will put you one more question, which relates to Ukrainian Cypriot double taxation agreement, additional protocol to it, because it got a lot of discussion here in Ukraine now. That's with the real estate clause and with taxation of capital gains. Because normally that's the intention of Ukrainian government was at the time of ratifying and devising this protocol, to capture the capital gains out of real estate rich corporate rights. Yeah, so whenever you have real estate in Ukraine and any shares of Ukrainian foreign companies derive its value from real estate, it should be taxed in Ukraine. That's the general perception. But now we have in the protocol and double taxation agreement situation when even if it's not real estate rich shares, of Ukrainian or foreign companies which are object of M&A transaction, which have been sold, then still we may face a situation when it is taxed in Ukraine, not in Cyprus, just because the subject to tax clause that we have in respective article of the convention. What is perception in Cyprus of this norm? How would you treat, and maybe you know just the governmental attitude to it, just to know?
Yes, I don't think we know more what is in the protocol, but what we can share is that a bit the perspective of here in Cyprus. This clause is the only one that Cyprus has from what I remember and from what I see, because I almost read all the treaties of Cyprus, that has this rule. And so the situation is also here quite new for Cyprus, because we never had these rules. I'm not talking about the property rich clause. That's something that most of the treaties now they have it. I'm talking about the situation where there is no property at all in Ukraine and you're just selling the shares of the company. It's something new. What we know is that probably there has to be some understanding between the two countries on the political environment to see whether these rules follow to other treaties or whether it's just Cyprus and etc. And if it's just for Cyprus, then they have to see why it's only for Cyprus, and try at least to be in a fair ground with all the other countries between the treaties. The other thing that something that else that have to be seen is this subject to tax clause, which it clearly has a specific meaning in the treaties, which is you need to pay tax in Cyprus. And if you don't pay tax in Cyprus on this transaction, then the other country can tax that gain. So here, there are also different discussions in the Cypriot income tax legislation for making the income tax legislation of Cyprus. And when I say income tax legislation applies to individuals and to corporates, there is a lot of discussion now in Cyprus to upgrade this income tax legislation. And there are discussions whether at least some minimum taxation can be imposed into this capital gains transaction to avoid any problems with the others. But all these have to be seen in the environment of we have to be fair with our treaty partners. We have to be fair with all the people in the community of the UN and of EU that we belong. So I don't have an answer on that specifically to say, yes, we will fix it. No, that's wrong. Or yes, we ignore it. No, that's wrong as well. There is a lot of discussion, Pablo, going around that. So we need to keep an eye on that. That's my view.
If I can add on this, Pablo, just for very quick, is that definitely this clause, as Demis said, is very, you cannot find it very often in any of the treaties around the world. Nevertheless, the countries that they have such clause in their treaties, Japan, if I'm not mistaken, is one of them. It's a complicated issue because it comes with many other side issues. And this is what we are going to expect in our case as well.
Yeah, okay, thank you very much, colleague. So I think that we'll be moving toward this approach when the income should be taxed at least at one jurisdiction. And yeah, it will be interesting to track how this most favored nation clause will be applied in our protocol, in our double taxation agreement. Okay,
Pavlo, you see as a make the different way of the discussion, to make it more active. So I think that the main idea from colleagues is that it is much easier to set up a new tax than to negotiate with Ministry of Finance of Ukraine on abolition of the subject to tax, because subject to tax and liable to tax is a bit different rules. So I think that it's interesting idea and we should follow whether Cyprus will introduce tax for these particular transactions because of Ukraine. Really interesting.
might be
Thank you.
Mm-hmm. Yeah, that might be so. Okay, interesting. We'll come, if we'll have a time, and I hope that we'll have a time at the end of our event, we'll come back and address some additional questions on Cyprus. And now we thank you very much, colleagues. Indeed, we appreciate your involvement and sharing with us your thoughts. Thank you very much. And I'm passing to the Polish jurisdiction and would invite Ms. Malgorzata Karbowiak for some intro of what is going on in Poland, and we'll just gladly listen and share our views on that as well.
Hello everyone. So I will try to share the presentation first. Okay, So Polish government has implemented up to date a lot of BEPS regulations. And apart from CFC, MDR, and TP, which are the hugest, I would say, we have also small, if we can say, small regulation that, in my opinion, also deserve discussion. And let me start from the smallest one, and then we, at the end, we will discuss in more precise the biggest issues. So let's start with VAT and place of supply of electronic services. A new definition was implemented, and this kind of services, when they are provided for non-taxpayers, shall be taxed in a country of their location, so their seat and so on, right? And the second thing relates to hybrids, so the action 2 of BEPS. And the newest thing in Poland is the implementation of ATAD is applicable from 1st January 2021. And the second thing is Parent Subsidiary Directive, which in which we have implemented also the hybrid calls. And what is important from my point of view, in case of payment of dividends, we have also implemented regulation according to which the so-called participating loans cannot be exempt from tax with regard in relation to Parent Subsidiary Directive. Another thing is interest deduction. So this relates to fin capitalization rules. Poland has also implemented this regulation, and the limit regarding tax deductible interest is 30% of EBITDA. And what is important, these restrictions does not apply if the net debt value does not exceed 3 million Polish zlotys. So only when this the value exceeds this amount, we have to worry about the deductibility of interest. In case of harmful tax practices, Poland up to date has concluded 50 agreements with regard to exchange of information relating tax matters. And within this action, OECD also defines R&D incentives as it should be strictly defined what entities actually can use such incentives, and we do have regulations with regard to this matter. IP box, in case of IP box, it has a professional 50% tax rate in opposite to standard 90%. Of course, these regulations are not very easy and should be very precisely analyzed if a company actually would like to use such an incentive. And we also propose ruling to be so the company has a tax ruling actually as a confirmation. Another thing is SAR implementation. I will not talk in details about this because it's quite a huge thing, but we do have implementation of this issue. In case of PE, the definition has not been changed in Poland, so BEPS BEPS regulation has not been implemented here. But we do have a lot of things going on in case of measuring and monitoring in Poland, and our government is very interested in this issue. They want to know everything. And we have actually working standard audit file, mandatory in case of VAT. And there are also other files that are submitted on request. Actually, the Polish legislative also works on structured invoices. So the goal is to make everything electronic, and but the problem is that it doesn't always is as good as they wanted it to be, and there are a lot of problems with these things. But yeah, the goal is as it is. So it is much easier for the tax authority to control the entities. They have everything everything in an electronic way, and when they will have also structured invoices, then they will be able to control the company without actually asking us about anything. Mandatory disclosure rules, a very important topic, and in case of Poland, also very confusing. The regulations, unfortunately, are very unclear, and there are a lot of questions arising from it. Poland was, I believe, one of the first countries which implemented these mandatory disclosure rules, because it was in January 2019, as opposed to 2020, where that was defined in the AC6. We have wider scope of hallmarks, 24 to, in opposite to 15, that is defined in the AC6. We have extended definition of reportable tax arrangements, so not only cross-border arrangements, but also domestic ones. Furthermore, there is wider definition of covered taxes, because it also covers VAT and excise duty that are not listed in the AC6. And hallmarks are categorized into three types: generic, specific, and other specific. And you have two criteria that should be taken in account. First, the tax benefit criterion. So the tax benefit is the main reason of the arrangement. It is extremely important. And the other one relates to so-called qualified taxpayers. So it is shortly, it is the taxpayer who actually has to submit the mandatory disclosure reports. As you can see on the presentation, there are some thresholds with regard to financial data revenues, deductible cost of 10 million euros, and assets or rights involved in agreements in amount of 2.5 million euros. And what is important, a qualified taxpayer is also the taxpayer who does not exceed these amounts, but is related to the entity that does. Here I try to make a very easy scheme of tax scheme, so you can see how it actually works. And the most important thing is that in case of domestic arrangements, we have a qualified taxpayer rule. And in case of cross-border transaction, this criterion does not apply, which means that even if you are not qualified taxpayer, you will be obliged to make a report. The other important thing is that in case of so-called generic hallmark, there are a lot of these hallmarks, so I will not describe all of this, but and it should be also precise very carefully if needed. But the main issue is that in case of generic hallmark, we have so-called tax benefit criterion, and this is why I said it's extremely important, because if we can say that tax benefit was not the most important thing in the arrangement, so it's like we wanted to make arrangement because of economic business reasons and so on and so on, and tax benefits like at the latest, a result of it, not a reason, no, a result, not a reason, then you don't have to report, right? But in case of specific and specific hallmarks, this criterion does not apply. And in Poland, it was at the beginning, it was quite a disaster when it comes to these reports, and nobody knew who actually should report, what should be reported, and so on and so on, whether it was promoter, a taxpayer, or a cooperating person. And there are two approaches actually. First is to report everything. It has to be to ensure that you are covered. You report every arrangement. Doesn't matter if it is generic, hallmark, specific. It doesn't matter. You just report it. If it's not should be reported, then just it will not be registered. But in my opinion, in the opinion of our firm, we think that it shouldn't be this way, because we shouldn't report as a tax scheme something that results directly from law. So if a legislator allows us to use some kind of benefits, like this IP box that we are talking about, for example, then it shouldn't be understood as a tax scheme. And Minister of Finance issued some kind of explanations, and they explained it's also this way, but it doesn't mean that it is easy. So and every transaction, every arrangement that is made, that you have some that you worry that might be a tax scheme, you should analyze it very, very precisely, and firstly think about whether tax benefit is actually the reason of an arrangement. Control foreign companies. These rules are also implemented in Poland. We have two-level definition. First, you have to determine whether the entity is actually foreign, so it relates to actual location of the company mainly, and then you have to determine whether the controlled entity, where the foreign entity is controlled, right? And we have three categories of foreign control entities: situated in tax haven, in country where there is no agreement according to which the tax authorities can obtain tax information, and the other entities also shall be deemed as foreign control entities if jointly three conditions listed here are made. So we are talking about 50% of shares. I think it's a quite standard condition. A second one relates to revenues of so-called passive income, so dividends, interest, and so on. And these revenues shall amount to at least 33% of total revenue of such company. What is important that I will just let me find something, because as a parent income, we understood also income derived from transaction with related subjects in case where the entity does not produce in connection with such transaction any added value in economic terms, or such value is negligible. So I think that this gives tax authorities quite right to to determine to include a lot of transactions here, right? So tax rate in case of CSC is standard Polish tax rate, 90%, nothing strange here. And other regulations are also quite standard. So we have surplus of total revenues over tax deductible cost, of course, proportional to the period where the company was actually CFC. And also we have a possible exemption if CFC liable to taxation its total income in EU or EM member state actually conducts economic activity in the state, and is the only exemption there it is. And transfer pricing, the main, the biggest, I think, issue, and we do have implemented OECD directive also in Poland. We have implemented two-level TP documentation, local file, master file, and country-by-country reporting. What is important, local file obligatory has to include benchmarking study. Firstly, it was subject to an amount of revenue from the previous preceding year, but now every local file has to include benchmarking study. It is very important because of the market level, because all transactions have to be at the market level, right? And the benchmarking study should be updated once every year. So. In case of requirements, with regard to local file, master file, and country by country, there are, I will not maybe read it. You can see here what kind of thresholds are. Each documentation has its own threshold. In case of local file, we're talking about revenues. In case of master file, we are talking, and country by country, we are talking about consolidated revenue of the capital group. What is important in case of local file, some transactions are exempt from transfer price documentation, and these are transactions that are subject to APA, that are concluded within tax capital group, and that are concluded between Polish enterprises that did not demonstrate tax loss in the given year. And overall, the rules regarding what should be included in all three types of documentation is consistent with OECD guidelines. So there are, of course, there are maybe some small differences, but not important ones. So mainly what is written in OECD guidelines when it comes to information that should be included in DP documentation, it is the same that is implemented in Polish regulation. But we do have two additional documentation. First is transfer pricing statement, and second one is information on transfer pricing. The first statement should be signed by the management board of the company and should be submitted electronically. It's important because in case of foreign companies, sometimes companies where management board is abroad, sometimes it's very difficult to obtain in short time the electronic signature. So it is important to remember about it. And in this statement, the management board states that transfer pricing documentation was actually prepared on time, and what is very important, the transfer prices are at arm's length. And what is also very important, as this statement is understood as a declaration in Polish tax point of view, if the statement is not true, then a management board can have penalties, personal penalties with regard to this matter. Another thing is information on transfer pricing is additional information actually summarizing everything that is described in transfer pricing documentation and benchmarking study. There are a lot of information there, financial data, benchmark, market level range, and so on and so on. And in case of standard transactions, so simple transaction, it's not difficult to fill in. But when we have a company, for example, where a lot of loans are granted, then it's very difficult to to find a way how to include the information so it actually presents true facts. Another issue with regard to transfer pricing that might interest you is safe harbor. We have two transactions within this low value added services and financial services. In case of low value added services, there are the following conditions: a markup at amount of 5%, which in case of purchases should be not higher than it, and in case of sales services, not lower than it. Another thing is that the company, in order to use safe harbor, have to have information about cost basis of remuneration and cost allocation keys, because we all know that sometimes we just, in documentation it's written that we use the cost plus method, but actually nobody knows what is the cost basis. And we have to have very, very detailed information. So we have to be able to actually using our financial data, calculate this markup, this exact markup. And the other thing, of course, it does not apply to tax haven. Financial services, we have a loan period, maximum 5 years, total amount limit 20 million PLN, and the interest rate shall be based on the base interest as well as margin that is defined by Ministry of Finance. Actually, at the moment, in 2021, the margin is 2 percentage points in case of lender and 2 points in case of borrower. And when we do have this kind of services, it is understood that arm's length nature is that they are concluded at arm's length nature. So it's not verified, and we do not have to prepare benchmarking study, which is, I think, would be a very good thing. So, especially in case of loans, it is good to think so the interest is similar to the one that is defined by the Ministry of Finance, and we do not have problem with benchmarking study, and we are sure that everything is all right. And just three very short things related to transfer pricing that were defined in action 8 to 10. In case of intangibles, we have a definition of hard to value intangibles and some special measures to be included in benchmarking study. Also, in case of functional analysis, risks, there's definition of ability to bear a given risk, as risk was also very often used as an explanation why the price is so high or so low. This is why this definition was implemented, and it is ability to bear a given risk is understood as ability to having control and actually have financial resources to bear the given risk. And what is interesting, we have some definition that we call proper transaction, which gives the tax authority right to reclassify our transaction. We would think that the company, the enterprise, is the one that knows best what they're actually doing, but it seems that it can be that they don't, because tax authority has a right to analyze the transactions concluded with unrelated parties and decide whether these parties would actually conclude such a transaction at all. A good example are head office expenses, right? Because you know that in a group of companies, it is often such expenses are incurred, but unrelated parties, I believe, that would not want to pay such costs. So that's all I wanted to say, very, very briefly, very shortly, because we don't have a lot of time. There are a lot of issues that could be discussed, but I tried to choose the most important one. I hope I managed. Thank you.
Yeah. Natalia.
Pavel, I have a question or comment to Malgorzata about the most recent proper transaction approach. I think that this is very, very rational approach, because you see, if, for example, we took requirements of our banks for when they open the bank accounts, they are looking on the activities of the company and then compare with the substance suggested for analysis. And we saw the cases where the bank refused to open the account because the company declares that it will provide services, but there was no any personnel on the company except for directors. I think that may be like a natural realization of the approach that existed in as a practice, and that now Poland put it to the rule that if we are going to provide services and we are talking about substance and further communications in Poland with tax authorities, please consider that your company shall demonstrate how it will act and how it will, and the same for your counterparties. So it's really a very good question, and we have in Ukraine also the examples. Thank you. Very good comment.
Thank you.
Yeah, thank you very much, Malgorzata. Maybe one more question that I'll just ask on my behalf.
I will try my best.
Yeah, this Estonian model that you are going to implement in Poland, is it already in force? And what is your perception, whether it will help and enhance the tax system generally in Poland, or that's will have only limited effect?
I must say that I'm not sure, unfortunately. Personally, I did not have, a client who had this kind of issues. So I have not analyzed it in this precisely. But having in mind how Polish authorities actually works, I believe that they will strictly follow each rule, because this is what they do. And actually, at the moment, it is the tax authorities look for, I would say it very, very, like to the point. They look for money, right? So they look for any issue that might create a tax income from the tax authority point of view. So any regulation that is for their benefit will be, in my opinion, surely followed. Of course, we can discuss with them, right? We always can. But the actual standpoint is that it is.
Yeah, here
very strict regulation, very strict perspective, a very strict standpoint at the moment.
Yeah, I guess the tax authorities here similar to those in other jurisdictions.
Yeah.
Yeah. Okay. Thank you very much for your contribution and covering the Polish topic very thoroughly. Thanks indeed. So we are moving further to our colleagues. Yeah. To Mr. Gaspar Lopes Diaz. Gaspar, the floor is yours. Please share with us your views on what is going in Luxembourg and in UK.
Yes, thank you. Thank you very much, Pavlo, for the introduction and for the opportunity to present to all of you at IFA Ukraine. So let me just share my screen. Just bear with me a moment. So I have a short presentation indeed on the UK and Luxembourg tax updates. Let's see.
In the meanwhile, I think that Luxy and UK is a good example to comment whether UK companies migrated to Luxembourg already, or how many UK companies migrated to Luxembourg, how many to Switzerland, whether we have any Cyprus.
Yes, yes.
Migrations.
Oh, okay.
Yeah, oh, here you are.
Can you all see my screen?
Yeah, we can see. Mm-hmm.
Wonderful. Well, to your question, I would say that we deal. So I'm indeed based in London, and I've worked quite some time in Luxembourg as well, and here in London in another law firm before joining Taxand Cyprus, and Brexit happened concomitantly with the pandemic. So there's a lot of things that had happened before already and others that are happening throughout this year, but with the additional difficulties because of the pandemic, of course. So moving people is particularly difficult when you have restrictions on travel and so forth. In any case, we see quite a lot of our clients moving businesses to Cyprus, and also, of course, private clients. But the businesses moving to Cyprus, I think, happen because of several reasons. One is that Cyprus is a common law country, it has close ties to the UK, that's well known, and also because the Cyprus is a European jurisdiction with access to the directives and to the European framework. So it's well placed in that sense with a number of competitive elements. If you think about tax rates, no withholding taxes and so forth in relation to other countries such as Luxembourg. Of course, Luxembourg has a number of advantages as well. But I would say, and that is a nice, if you allow me, a nice mod to start my presentation on Luxembourg, that what happened since this year is that the investments are a bit frozen, not a lot has moved, and in tax, not a lot has changed. There are novelties also on the funds area. So the Luxembourg is always reviewing its fund regimes. Some forms were removed from the law because they were not used as much, and it is discussed that perhaps a new SV regime is coming, or further changes to the SV, to the securitization vehicle, might be coming. which may be of interest to Ukraine and other jurisdictions, especially because they have different treatment in terms of the beneficial ownership register. So they allow some level of discretion for the investors, which is also welcome in places where, especially if we think of Latin America and other places where private clients may be afraid of having their names disclosed and their assets disclosed publicly. So, as I said, not a lot has changed, but let's look at what has changed. There's a few points that give an impression of the direction where the country is heading, and I think it's for Luxembourg, it's a matter of consolidation. So there's not a lot of dramatic changes. A previous point before I go into the points on the slide is perhaps of interest that there is a new treaty or an amendment to the treaty between Luxembourg and Russia that provides for no withholding taxes on interest and easy access to the 5% rate for dividends. Now that's not surprising, but worth mention. And of course, Luxembourg has 15%, otherwise domestically 15% withholding tax on dividends and no withholding tax on interest. So it's not, it's not surprising. Still on the tax treaty network of Luxembourg, which counts approximately 100. A bit under 100, I would say it's 80 something treaties. There is now a circular from the Luxembourg authorities on the procedure for the mutual agreement procedure. So the internal procedure, the circular is issued in French as usual, but more importantly than the content of the circular, which is now not groundbreaking, is the message that the tax authorities in Luxembourg have the capacity and the willingness to enter into mutual agreement procedures when needed, and to try to also be hopefully be helpful in avoiding withholding double taxation in the scope of the treaty with the treaty parties. So that's perhaps a positive message. And by the way, there's other in recent years there has been an increasing focus on certain areas. We'll come to transfer pricing, but transfer pricing is an area where internally the head of transfer pricing at the tax authorities became responsible for audits, and therefore it's expected that there will be some emphasis on transfer pricing in the review of tax returns going forward. So that's perhaps an interesting note. A few other points. It will come as no surprise that the IP regime that allowed for a deduction of 80% of the income in Luxembourg will come to an end now in June 2021. So this is is coming to a closed chapter at the end of the month. Unsurprisingly, as well as Demis mentioned, and this is happening across the board in Europe. He mentioned it for Cyprus. It's true also for Luxembourg. So there's a new law that has been passed in Luxembourg which denies the deduction of interest and royalties to blacklisted jurisdictions at the level of the EU. A few countries there are Panama, Seychelles, and a few others. There was, I don't want to say something wrong, but those are, let me just double check the full list. The countries included Barbados, yeah. So that's some of the jurisdictions that you might see in structures, and those are included. So those are perhaps now in scope of in scope of this law, and certainly in scope of reorganizations, because the law entered into force in March this year. So it was implemented very quickly. Then you may or may not be aware that there was a case 749/18 of the Court of Justice of the EU, which addressed the fiscal unity regime in Luxembourg. So the fiscal unity regime in Luxembourg was considered to infringe the freedom of establishment, the EU freedom of establishment, because it would allow a domestic head of the fiscal unity to have a vertical fiscal unity and also a horizontal fiscal unity, whereas a foreign EU parent would only be allowed to have a vertical fiscal unity, and if it wanted to enter into a horizontal fiscal unity, it would have to dissolve its existing fiscal unity. So this was changed, and there's now a transition period until 2022 for the change to be made with a few conditions, but this is worth noting and very welcome. Then a few other short points. There is a lower subscription tax rate for undertakings of collecting investment that invest in green activities, sustainable economic activities, and if the lower subscription tax will correspond to the percentage of green investments in the UCIs. And lastly, I must say that the Luxembourg SPF, Société de Gestion Patrimoine Familial, it's something that is not seen too often, but it's basically a personal holding for Luxembourg individuals, and its activity is further restricted. So it's now prohibited from holding real estate assets via partnerships or FCPs, which is a regulated fund, Fonds Commun de Placement in Luxembourg. So I would say that the climate in Luxembourg, to summarize and conclude, is stable, is consistent with what we have seen in prior years. No dramatic changes. The tax rate has been decreasing every year in recent years, but now it has remained stable. So I think that there's also, in terms of investment in climate in general, a bit of a freeze, waiting to see what happens over time. There is, of course, interest in funds from the UK to have activities in Luxembourg, but mostly those are regulatory and support functions and some distribution functions because of the ability to repatriate proceeds from the funds. So nothing surprising. Moving on to the United Kingdom. The atmosphere in the United Kingdom is somewhat different. I would say that there is a conflict of optimism and pessimism, because there are a lot of measures that are clearly destined at enhancing the position of the UK from a competitive point of view. That's clear. But at the same time, there's a need for revenue, and therefore you can expect closer scrutiny from the authorities. So firstly, what we have is an increase of the corporate tax rate from the current 19% to 25% as of April 2023. By the way, the United Kingdom and other, and this may not be a novelty for other common law countries, has a different tax year starting in April, which has to do with the beginning of the harvests historically. And to go with that, there's also, because that's such a bad news, the budget also includes some good news, so that there is, for example, a 2-year super deduction of 130% for plant and equipment, and a temporary 3-year carryback of losses, which used to be not possible. And this is also, of course, considered in light of the pandemic. Both for Luxembourg and the United Kingdom, there were extended periods for filings of corporate tax obligations and other obligations. And also both the United Kingdom and Luxembourg have used the 6 months extension, which was possible under the DAX 6 directive. So that's it. A very interesting point is that the HMRC has opened public consultation on transfer pricing documentation requirements, and the idea is to enhance those documentation requirements and make to further align the obligation to prepare a master file for UK multinationals and local files in line with international standards, and to share information on a regular basis on transfer pricing. So there's an enhanced attention of the tax authorities and the Treasury on transfer pricing. We will come back to transfer pricing in a second, and I'm also won't take too long. I want to highlight a very recent case law, which was decided by the Supreme Court just 2 days ago, 8th of June 2021. Supreme Court clarified that HMRC has the ability to charge tax going back 20 years. Now, of course, this was a possibility, but there was most advisors, or there was a view amongst advisors that, and of course, conflicting interpretations and also divergent case law that said that in order to go back, that I won't get into all the technicalities, but basically the HMRC has to issue a discovery assessment, and that discovery assessment would need to uncover the existence of some either a willing wrongdoing or at least some level of negligence. And the court has broadened that concept and made it much easier for the tax authorities to effectively go back up to 20 years. And my take from this is that the level of demand on the quality of advice and compliance in the UK becomes very, very high, because we need to think about tax rules today, but also how things are going to evolve and how thorough investigations may be many years from today. So that's somewhat perilous for taxpayers. Then, of course, it will probably not be a news to everybody that there is a digital service tax in the UK applied at the rate of 2% on revenue from digital services as of April 2020, so last year. And it applies to search engines, social media platforms, and online marketplaces. It's interesting, I'm talking about it in particular because now with the Biden agreement, it's interesting to see how measures like the DST will evolve, because there is international pressure and an agreement at the G7 level, which is, of course, directly impacting the UK, to abolish temporary digital service taxes, and also possibly the diverted profit tax, the DPT, that has been given rise to huge discussions and inquiries by HMRC.
Gaspar, may I clarify? The DST is a part of the corporate income tax, not VAT, correct?
DST is a special tax that is levied on revenue, so it's not levied on income. So it's a different tax, a separate tax.
Yeah. Okay. Thank you.
And taxes in the UK have a special status in the sense that all taxes need to be enacted every year with the budget. So the whole tax system needs to be approved every year in order to be levied. So there's these particularities. This, by the way, concludes my presentation. If anyone has questions, thank you very much for listening to me.
It looks like, Pavel, that UK may face the amnesty of capital because of this 20 years back possibility. Yeah. Otherwise, they may have a problem.
Yeah, that's might be interesting issue as well. But still, I guess with the DST, Gaspar, that you surely we'll see how the things will be developing, and maybe that's the question that we'll discuss a little bit at the end, because some countries have already taken some measures in advance, and now once we have this preliminary agreement on Pillar 1, Pillar 2, there might be some unification. Maybe UK will somehow reconsider its approaches to it. But may I ask you a question on Luxembourg? We just remember that there was an issue with tax rulings there. How is the situation now? So I mean, whether it's possible and under which conditions to and necessary just to get the tax rulings for those businesses who would like just to their structures to be secured for some tax authorities claims there.
Sure. Yes, thank you for the question. I think that's definitely something that we all have in the back of our minds. So there's a few elements to that. So I will remind that as of the beginning of 2017, all tax rulings relating to transfer pricing, prior tax rulings and APAs were revoked. So we have a clean slate for transfer pricing as of 1st of January 2017. For other rulings, there are different validities, different validity periods. And there's a very interesting PhD publication from I think 2 years ago on the validity of rulings from a PhD student in the Luxembourg in the University of Luxembourg that is worth looking at. But basically, the tax authorities, so the rulings in Luxembourg, of course, are subject to exchange under the European framework and under the BEPS framework. The rulings, as you know, are changed are exchanged on request. There's an automatic exchange of the summary and then follow up upon request. And in general, there is, since 2015, things have started to change. There is now a ruling committee and the procedure. There's a circular that governs the procedure, so things are more transparent. And of course, they have had, as you all know, huge scrutiny from multiple bodies, in particular the European Commission. The state aid cases that arise in relation to transfer pricing APAs and rulings have been won by Luxembourg so far, but they also represent a warning to the views of the Commission, and on the one hand you have the legal interpretation, but you also have considerations regarding reputation for multinationals and the individuals, funds, etc. And so those are things that need to be weighted. The tax authorities, as far as our practice is concerned, are willing to issue tax rulings. We see from the numbers, because there's summaries of the tax rulings that are published every year, we see from the numbers that there was a dramatic drop in APAs issued by Luxembourg. There are nonetheless some APAs that continue to be issued and some tax rulings that continue to be issued. But certainly up to 2015, there was a huge focus on obtaining a ruling for a lot of transactions, and that has gradually changed. And I would say that as of 2017 and up to now, that has become a more case-by-case specific and not a generic approach to all investments in Luxembourg.
Okay, thank you very much for this clarification. With respect to UK, one short question probably. Will this Brexit process mean that UK withdraws from all EU directives. I mean, mother, subsidiary, well, okay, subsidiary, parent directive in particular, and other, on royalty, on interest, and so on. Or they negotiate somehow just to keep applying them afterwards.
So there is no. There is quite a lot of uncertainty regarding the details, but there's no, so a lot of the provisions, a lot of European provisions have been repealed already. And of course, I would say that there's no big change for the parent subsidiary directive because the regime in the UK as it stands has not, nothing has dramatically changed. And on the contrary, the participation exemption or the rules applicable to dividend are very broad and generous. So it's not very difficult to obtain exempt dividends or generous credits for dividends received by a UK entity, and the UK historically is a credit country, so there's ample. I would say that there's little concern there. For interest and royalties, it can be more. It's more nuanced and depends on the country that we're looking at, and we may, in some cases, fall back in the protection. We look back at the protection of the treaty, if any. And but the UK is looking into revising the holding regime, and there's some consultations on the way by HMRC and by the Treasury, and also is looking into introducing a new fund regime, also in a way to compete with the regimes of Luxembourg.
Mm-hmm. Okay, thank you very much for covering these two jurisdictions. Indeed, it was very interesting to us. Natalia, then I'll pass the floor to you. So. Yeah, you can upload your presentation. Yeah, and
thank you.
Your case on DAX 6 and generally how Ukraine, what lessons may we learn from all this?
Yeah, actually, it may not be a surprise that Ukraine, similar to European countries, was quite open to introduce the BEPS initiatives. In order to switch your attention, my presentation will be in Ukrainian, but I will comment in English. It's just for audience in order them to be a bit refreshed. So Ukraine was quite open to implement all these initiatives, and even DAX 6 directive has an impact. And I think that from our practice, what we've done with our clients in Ukraine for many European jurisdictions, what we analyzed and which conclusions we take. Now I will tell you what is the most important lessons learned from this process. So for your whole understanding, as usually, let's look at the BEPS steps and how Ukraine responded to these steps. So step one, digital tax. We have the law adopted quite recently on the 3rd of June, and we are waiting for the signature of the president. This law, if it will be enacted, will introduce VAT for electronic services provided by non-residents to Ukrainian individuals. This law may be enacted starting the next day or after the promulgation, or for certain part starting from the 1st of January. We are quite optimistic that the president will support this initiative. This is not easy to have it accepted as an economy, because that may change the balance in our pricing in Ukraine, and how foreign companies will process the electronic services. So it's time for consultants to help as usually. So about the hybrid instruments, Ukraine is not implementing this because we do not have such. On the CFC regime, step 3, we may have these rules effective 1st of January, but do not forget that we have a new reform facing in the parliament, and it may delay the introduction of CFC rules to 1st of January of 2023, but in general, the approach to CFC is same as in OECD, but we are following the Russian model where the individuals will be reporting persons, as well as Ukrainian companies if they are controlling bodies. So really time to be prepared. And step 4 about the limitations on interest deduction, we have newly updated rules starting the 1st of January on the thin capitalization rules. For step 5 on the harmful tax practices, I think that Ukraine still have such, but they are a bit hidden. We are not in the list of countries with harmful tax regimes, which may have impact to transactions with other countries, and actually we in Ukraine are trying to control the transactions with low tax jurisdictions or offshores. We have our own list and we have our own GAR on the transactions, and we think that maybe the recently adopted rules on the disclosure of the shareholding structures of Ukrainian companies, which have to be implemented in 3 months, like similar as Cyprus, for example, have. So our greetings to Cyprus. We have the same temporary or interim period to introduce additional information to our register of companies on the ultimate beneficial owners and disclose the structures. It may have importance. Please pay attention if you have trusts in your structures, and the trusts beneficiary own Ukrainian companies. So please pay attention. As regards step 4 on abuse of tax conventions, we have MLI implemented, and we have 2-tier tests on beneficial owner of income and on the principal purpose. We have positive court practice, thanks God. So it may be also considered as generally according to the OECD principles. So we can be more or less comfortable with how we assess these 2-tier tests. On the step 7, the permanent establishment rules, we have a newly updated legislation. It's applicable starting the 1st of January. The rules are not easy. There is a bit misunderstanding still how we will report. We have 2-tier registrations, but still, I think that starting this year, our tax authorities will have effective instrument to follow not only the registered offices of non-residents in Ukraine, but also other cases where non-residents act as a business in Ukraine, and this income shall be taxable. And the penalties are not huge, but there is a risk that assets of such a non-resident may be in danger and maybe even put in a seizure. So interesting time this year, starting of implementation of these rules. About transfer pricing rules, we are quite good. This is steps 8, 10. We have rules implemented. They are with the standards of OECD. About the analysis of data on BEPS implementation, there is no particular instruments to assessment in Ukraine. because we are busy with other processes as regards BEPS. On the mandatory disclosure, this is the most awaiting development, meaning Ukraine is in the process of technical negotiations on the technical side, which will then be followed by the negotiations with the particular countries on this exchange. We see that physically it may be possible to start exchange, if everything will go as it is planned, only by the results of 2023. But this is our best expectation. Maybe the situation will be not so positive, because our previous assessment was that we may start exchange on the information on 2022. Now we think it may be in 2024 for 2023. About the CBC reporting, we have a new legislation effective 1st of January. We have to prepare CBC reporting based on the certain thresholds, but we're still waiting for the signing of appropriate international agreement on this reporting. On mutual acceptance procedure, we have appropriate provision which is introduced to our tax code, and almost all our new double tax treaties have such procedure in the double tax treaties, and now we have it in the tax code as well. And finally, about the step 15 on multilateral instrument, it is effectively implemented for example, Cyprus. It is implemented starting this year, and we think that that will be an effective instrument to check the avoidance of abuse of double tax treaties rules. So why I think that it is important to talk about step 12, about the tax 6 and our Ukrainian impact of this initiative, because almost all or each big group in Ukraine, in each industry, may have European countries as the trading companies or as a holding or as a financing company. And if we have such companies, we are facing the situation when we have to check the previous periods of activities of our European countries, and we have to plan further activities. And what is important in many cases, the decisions on how to plan our taxes in the group are taken in Ukraine or with actual with participation of Ukrainian staff, and not each time the management company or the management personnel of the group is located outside of Ukraine, and where this intermediary may be located. So just in order to give you understanding where the Ukrainian company may be in this structure, how the DAX 6 reporting is acting, the Ukrainian company may be intermediary, which is out of European Union, and where is located our European company. This is also maybe an intermediary if it is, for example, management company or holding, or our company, which may be the person who reported to the tax authorities is a taxpayer. He is also part to this reporting. What shall be disclosed and what is the main impact of this reporting? So we have to consider each and any case where we proceeded with aggressive tax planning or particular transaction, which is considered by this directive as a reportable. We have to look we have to include to this analysis very wide range of the transaction, and then make it narrow based on the particular reasons or features that the particular transactions that shall be disclosed will give us not a solution, answer to the question: do we have to report this transaction as aggressive tax planning, or if we will not report, whether we will be penalized, and which particular company shall report. I think that in case of Ukrainian groups, we may face the situation where when the holding company or principal entrepreneur of the group, if it is European company, may be facing the requirement to disclose the transaction. You see that the reporting has been already started in almost all countries. Cyprus, thanks God, delay the introduction of the legislation, and the penalties will not be applicable to non-reporting till the September. So Cyprus have time to consider whether there is still a necessity to report something. But actually, the process has been already affected. The penalties may be applicable, and for example, we see the experience of Poland, which have been already implemented the legislation for almost 2 years, and we see how the practice is going on. Actually, you may be on the safe side if you have a good intermediaries like Demis said, and Costas. It is tax advisors, your lawyers, your banks, your financial advisors, who are primarily responsible to follow these procedures. In Poland, for example, mostly it's about the financial institutions, the banks and insurance companies. They are in the focus of the reporting. And if you have, for example, Deloitte as your service provider in Poland or in Malta, in UK, it would be primarily responsibility of Deloitte to check whether the advice that was provided in the considered period was structured in a way that may be considered as advice for aggressive tax planning. And if it is the case, then Deloitte shall report and inform the company which asked for this advice, the taxpayer, about such reporting. And what may be the result? The result may be that when the tax authority in particular country will aggregate certain information, and it will take time, they may then challenge the benefits that you get in different transactions. It may have impact then to deduction of your tax, to exemption applicable to your tax in particular jurisdiction. And especially we have to look at our transactions with, for example, US, with offshore jurisdictions, etc. So any situation when we may have, for example, deduction in European Union and non-taxation at the level of recipient, or even double deduction, or particular transaction when certain assets, functions, and risks are transferred from one company to another, and this will change the tax basis in different countries, and that may be different. So the process that we see in our in the management of our clients is that one time you have to assess in general and very widely the whole transactions that may be considered as reportable. In very simple way, we have 5 clusters: A, B, C, D, E, which include, for example, such kind of transactions which may be considered as reportable. Please pay attention that only three sections of these hallmarks will be subject also to be principal purpose test, because even if you have such transaction, but it was business driven, it will not be reportable. But there are 2 others which by itself shall be reportable if you have it. then what we see as the most popular hallmarks, which we see is reportable in the jurisdictions which have been already in the process. For example, UK, please pay attention only to the section D. Others hallmarks are not applicable to UK, and this is very clear that UK is protecting its companies from excessive reporting, maybe, or try to be more independent with this process. So even being part of this legislation, UK is a bit independent. For Netherlands, for example, you will have questions with the section B, with section C, especially as regards the benefits based on the double tax treaties or parent subsidiary directive. So the Netherlands is clear about such kind of transaction. About E2, it's transfer of hard value intangibles. So if you have, for example, software which you would like to move from one company to another, and that will be cross-border transaction. So, for example, from Malta to US, such particular transaction shall be reportable on Malta, even if the price for this hard value intangibles will be immaterial for you. Still, the main lesson learned is if you have doubts, report or not report, please report. That will at least decrease the risk of penalty that may be applicable. And also the transfer of functions and risk. In Poland, the same approach, but as Malgorzata said, Poland has absolutely different landscape on the DAX6 because an internal transactions, not only cross-border, may be also reportable. In general, what we may give you as helpful information is that there is no different rules for audit of DAX6 rules compliance. So everything, all the checks will be done within the normal, usual tax audits and within the usual terms. So there is no special time to look back to the period. So if you are facing usual tax authorities may check whether you are in compliance with DAX6 rules. And it is not so many cases when we see, but still in Poland, we know that the penalties were implemented. And what is interesting for Poland, even if you do not have nexus like Ukrainian, me, for example, being a partner in Deloitte, and I am providing advice to Polish entity which may be considered as aggressive tax planning, I have to report as a person in Poland on this transaction. And if I will not, and that will be revealed, I will be penalized, and that will be my particular responsibility. So really, without having nexus in Poland, I may be me as an example, so it's not about me. So that may be a case. So a really interesting situation, and Ukraine shall check this situation. Also, if you are using specific regimes and you pay to a tax advisor if they will provide you with advice which will increase or decrease your ability to receive this tax benefit, and the compensation for this service will be based on the amount of benefit you will receive. This is also, for example, for Poland when you may face the necessity to report. What is not reportable if you talk to your tax advisors? You will not report if this is general advice. Please do not ask your tax advisor to give you the way how to avoid taxation, European Union. This is direct way to reporting. If you, as a tax advisor, submit tax returns and you are aware of some tax schemes, but you just submit tax return, or TP returns, or you making DD report, due diligence report, and you may know about some schemes. This is not. This doesn't create an obligation for your advisor to report, because we are just fixing the facts and going with our conclusions. So it's important. And you may go for advisor to get assessment whether particular transaction is reportable or not. This kind of advice shall also not be reportable. So if I, as a tax advisor, is aware about the reportable transaction, it does not create me as a reportable person as this intermediary. So what also may be interesting, that we think that if you proceed with such exercise one time, you may check how the compliance processes inside of your group has been built up. So whether the communication is effective, because sometimes tax function and legal function is not on the same side, on the same page, and it may conflict and may create impact on particular reporting, and you may due to this assessment, you may fix this bug in your communication inside the group. You may then find, you may not report some transaction, for example, if you think that they are business driven and no way to treat it differently, but you may check then the situation for the future. If you will have the same transaction, but the business driven factor will be missed, that will create not good situation. So what we would recommend, just do this check once for your transactions. If you have European countries and you have any of the transactions which are in the list, then consult with the tax advisor, for example, second time, whether you have obligation to report in the particular country, and after that it's still your decision whether to report or not. So that is quite a good exercise for tax function of each and any country. Here you will see very simple examples of this hallmarks which directly forward you to the reporting if you have Cyprus holding, if you have Poland core, other European companies, if you have Switzerland as a country with specific tax, not regimes, with a specific rates, and that may be also taxable reportable transaction. I think that all other slides you will see in the presentation. They are about how the MAP was implemented, how MLI will have impact to your transactions, and which transactions in particular we would like to raise your attention may be affected, and how the process of automatic exchange of information is structured in Ukraine and the appropriate dates. Pavel?
Yeah, thank you indeed very much for this, as usual, brilliant overview of what is going on. Yeah, and on DAX 6 and generally on BEPS implementation in Ukraine. I think that, yeah, I mean, just in Ukraine, we are still facing, and we need a little bit time to digest at least CFC plus automatic exchange of information along with FATCA. But after that, the most, I would say, painful and most important for business might be DAX 6, though we're not obligatory to implement it. But as you've just mentioned, still already now Ukrainian businesses are facing obligations to report even now, though we are not part of that legislation so far. So it's really Ukrainian businesses should look into it. Yeah, and I've just to mention, we'll share with all those who registered to our event our presentations of all speakers. So you'll have the possibility to look into them in details, and there'll be also a record of our event on IFA YouTube channel and in other resources. So we are 5 minutes after declared time. So I would I would like to say thank you to all the participants, to all the speakers, to all those who were with us online. Thank you very much. I think that there was a lot of insight, a lot of interesting information, because we see that the situation is changing with every month on EU landscape. And it is important to be updated and to see what changes are on the way, just to react properly. So we'll be glad to assist and help all of you with that task, and we'll think about future events which will be dealing with particular aspects of those changes. Okay, once again, thank you very much. Thanks to all speakers, and looking forward to seeing you at our next events, and all a nice and good day today.
Yeah, thank you very much.
Yeah, thank you very much.
Thank you, everyone.
Thank you as well.